we are back to looking at these markets from a macro lens. And what do we find? Stasis. Quiet day to start the week, but plenty of event risk facing us in the coming days, culminating, of course, in the crescendo that is the monthly U.S. jobs report. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at what awaits us in the coming days. But first, take a look at what the price action showed us last week and see if we can't surmise what the stage setting might be as this week gets underway. So here's how the markets fared last go round. Stocks a little bit lower, but not by much. S&P down 0.4%, NASDAQ down 0.6%. So not big moves, but certainly something that is sort of on the negative side, especially relative to what we saw in the prior week, in the immediate wake of the Fed monetary policy announcement, where the markets clearly had a more positive view of what is going on here. Last week, it seemed like the markets, on reflection, had a little bit of a different perspective. We can see yields higher, in particular at the front end, but across the curve, the 10-year up, the 2-year up. What's interesting here, of course, as well, is that while that occurred and the dollar went higher, euro down 0.4%, the yen an even more convincing 1.1%. Gold continued to surge, and as did silver, which we don't have here on the table, but we can get the sense from the precious metals just by looking at gold that they don't seem to really care about the story in rates. They don't seem to really care about the story in the dollar. The stronger dollar, the higher rates should be kryptonite for an anti-fiat, non-interest bearing instrument like gold, like silver, and yet they're continuing to power higher all the same. That might give us a sense of the moment here. In addition, of course, to the kind of slight fractionally risk-off vibe in stock markets, we get a little bit more convincing of a view in Bitcoin to the extent that it is kind of risk sentiment on steroids. There you get that decline of 4.8%. So kind of a soggy thing in the way that the markets performed last week. And when we look at the way we start this week, we get a bounce in Bitcoin, though, of course, it doesn't really take us out of the near-term range. There's a little bit of a correction in the dollar. It pulls back a little bit. The euro up a tad today, as is the yen, although, of course, given last week's moves, these amount to a correction rather than anything that overtakes what we saw last week. Yields tellingly come in a little bit, the 10-year down, the 2-year down, so bonds are a little bit higher. Stocks ultimately try for the upside, but don't really get very far. S&P closes up just 1 point, or just 0.16%. That's, of course, a pittance, especially when we consider that at one point today it was up 0.6%. So this was a much more meaningful move earlier in the day. Similar story for the NASDAQ. At one point, looking at this a bit earlier, sort of from the open to the high, the NASDAQ was up over 1%. Looking at it now, of course, we get a close of just a little over 0.3%. So momentum is certainly a little bit weaker. The standout today, of course, the nearly 4% jump in crude oil. But if we take a look at this sort of in the context of where things have been, this is not an especially convincing sort of move. This looks more like something that is still, give or take, within the confines of the range that we've been looking at for the most part. I mean, if we look at, in particular, the Z5 contract, we don't really have a meaningful departure from the range. We certainly have a potent gap. We certainly have a strong start to the week, but on the whole, the story seems relatively mired still, with a bottom around 60, 61 and a top around 65. Now, with all of this in mind, we of course see that, again, crude oil aside, because it seems to be on a mission all by itself, the general sort of vibe last week and going into this week seems to have mainly come from this adjustment in Fed policy expectations. And in particular, we can see for next year. So, of course, we had a rate cut here. So whatever the tally was before that rate cut, 140 basis points, you would expect it to come in some because this cut has now occurred, but it's come in more than you would expect. So 140 minus a 25 basis point cut would give you 115 basis points. Now that we're here at 92, there's about a 23 basis point gap. That is to say, the markets have shaken out 23 basis points out of the outlook beyond just adjusting for the cut that's already occurred. So the outlook for next year in particular has narrowed at 59 basis points. As a matter of fact, this is the least dovish that we've seen the outlook for 2026 since about, give or take, June. So mid-June or so. So we're talking a little bit over 6 months. And the view for this year has been pretty well steady since before the Fed policy announcement and through it. So from basically the beginning of September, the outlook for this year has looked about as it does here. And so with that, you end up with 2 rate cuts now. Of course, the Fed has said that they're out to 3, but even the markets don't really see that as credible. And of course, we've talked a lot about how the addition of Stephen Miran on the board has kind of skewed the Fed's averages for their forecasting. We can see right here, from a base of 4.4 this year, as of September, the Fed now envisions 3 cuts narrowly. It was holding on to only 2, but only by a very, very small margin. And when we look now at what's going on for October, we can see that in October, we're at this point fully baked in for another cut, 89%. But when we look at December, it's not nearly quite so convincing. We're at about a 70-ish% chance that we're going to get this cut. It's about 70-30. But if we compare it to what this looked like even a week ago, it was more like 75 and some change. Now, it is a little bit higher than last week. Last week, we got as low as 65%. So we're sort of on the fence, but it seems clear that the markets have made a sort of adjustment in a less dovish direction, ostensibly inspired by this revision to Fed forecasts, where growth expectations were increased, unemployment rate expectations were decreased, narrowly higher inflation was marked here for next year than it was back in the June forecast, from 2.4 to 2.6 on both the headline and the core. And so the market's looking at this and saying, well, the Fed is just not looking to do that many rate cuts. They're still baking in a lot more than the Fed itself. Obviously, we can see here the Fed's only got one rate cut for next year. The market's at 60 basis points, still see at least two, with a strong optionality for a third, but clearly they've backed off some. And we start to see those consequences. So the S&P, we can see on reflection, has kind of stalled, to give you a sense that sentiment is anchoring here as the markets start to think about maybe there's going to be less easing than they wanted or hoped for. And the dollar has attempted to carve out something like a bottom and is trying to edge higher as things get less dovish on the policy front. Now, that's our stage setting. We open this week with a bit of economic data outside of the US, and we start in the sort of Asia Pacific space. We move to Europe, and then the big event risk out of the US hits. So we begin with China and these PMI figures. This will give us a sense for how the world's second largest economy is doing economically. It's been mired in a deflationary slump for 9 consecutive quarters at this point. And we can see that the expectation for these PMI numbers is that we're going to basically remain stuck near neutral. So as ever, PMI numbers are centered around 50. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what we see here is that really since the beginning of this year, these official figures out of China have been hugging neutral. They've really gone nowhere fast. And it's largely because the economy is in this kind of anemic state where you can't really find any meaningful growth to speak of. And looking then, relatively speaking, to what this looks like in terms of global growth, we once again find ourselves in this sort of environment where the U.S. is the only game in town, because Europe is this kind of anemic, and for its own reasons, and China is expected to remain so. And so the only kind of meaningful growth that we really find anywhere on the board at this point seems to be in the U.S., giving us a single point of failure. Now, the Fed is obviously starting to cut rates because it's worried about sogginess in the labor market, perhaps giving us a point of failure, but certainly no evidence that this is any kind of an imminent danger at the moment. So for now, it looks like we're going to continue to precariously balance on the shoulders of U.S. growth, at least until there is some sort of give there. But if there was any hope that with that give would come some sort of a backstop from China, it doesn't look like we're going to see that this go around. Then we're going to get a rate decision from the Reserve Bank of Australia. They're expected to remain on hold here at 3.6% after a cut last time for the target bank rate. If we look at what the futures are pricing in here, that's the yellow line right there, we can see that's hovering around 3.3. In other words, here we are at 3.6. We're at 3.3 for the year-end expectation in the futures. So there's one more cut in this wedge here that's on the table. And so what the RBA is going to be interesting for this go-around will be a sort of barometer on global growth. They're relatively early in the supply chain in Australia, the global supply chain. And so what the central bank says about where we head from here and whether there's any more or less easing on the board, and whether this forecast broadly remains, that's going to be what's interesting for markets. Then we're going to get inflation data out of the Eurozone. The expectation is that we're going to get a rise up to 2.3% on CPI. Now, that would be a meaningful increase. We can see here with the naked eye that this would be the highest in a while. Indeed, it would be a 7-month high. The last time that we were at 2.3% was February of this year. What's interesting is that when you look at the breakdown of inflation, you see that most of it seems to be in areas that the ECB doesn't have much agency over. So you have a lot of it in food, in fact, the majority of it in food. One would think that this kind of stickiness in restaurants and hotels is in large part overlapping with whatever's going on in food. And there's also this kind of lingering issue with the cost of insurance that's moving around the miscellaneous component. But the main issue clearly is an almost full 1 percentage point of inflation being contributed from food and adjacent costs. And so this doesn't seem like the kind of setup where the ECB would look and say, well, inflation is obviously getting stickier. It's obviously doing something we don't like. Maybe we should think about raising rates. That is not the likely outcome. And of course, the markets don't see it as such. Looking at what we have that's baked in for ECB policy at this point, no more rate changes for this year, no rate changes for next year. In other words, whatever the euro might have found in terms of policy support out of an inflation number going higher here probably isn't there. And that, of course, might be interesting in the sense that the dollar has attempted to bottom against the euro and is kind of begrudgingly forcing its way higher since bottoming in early July. And that's despite the fact that the Fed has resumed cutting rates and there is no scope for it seemingly in Europe to push in a dovish direction. So the euro here under fire despite what might look like an adversarial setup for the dollar, where the Fed is getting more dovish, the ECB probably isn't, and yet the euro is starting to take incoming. So, if anything, this data might be significant in the sense that it allows that dynamic a touch point whereby it might be a little bit soggier going into the data. It might get the clearance to resume after the data. And so the data might be more relevant in terms of its passage rather than its substance. And then, of course, we get into the U.S. economic data flow. First and foremost, the ISM PMI report. The expectation here is that we're going to be relatively steady on the service sector front. This works just like any other PMI centered around 50, as we were saying before. So at 52 for a second consecutive month, the service sector is not running away, but also not falling apart. The situation in manufacturing expected to give us another contraction at 49.2, but the pace seen slowing a little bit. But looking at this on the whole, of course, more of the economy is services than is manufacturing, so skewing in that direction. We're probably somewhere at a kind of weighted composite ISM level of plus or minus 50 on the dot. And so the U.S. economy on this measure is basically standing still. The story from the analog PMI data from S&P Global is a little bit rosier, but it's also a little bit more volatile. So we had this very, very potent melt up in growth rates in the second half of last year. Then, of course, around the tariffs, this fell off as those tariffs were being rolled out. This was, in fact, a big part of how you ended up with the sell-off that you had in stock markets at the beginning of the year. That, of course, is this right here. Policy expectations getting more dovish, the S&P coming off. That was, in large part, this swoon in sentiment. Since then, it's come back, give or take, to where it started. But we can see the most recent readings here for the past 3 months or so ticking marginally lower. Now, this is where things get interesting because, of course, there is still this disconnect. And if it does look like the U.S. economy is starting to get a little soggier, well, then the markets will look like their expectations in their excess dovishness make more sense. But if not, then it's going to look like perhaps there's more of an adjustment to be made here, which might be more sogginess ahead for stocks, might also be more strength up ahead for the dollar, sort of along the lines of what we've seen already, where if this continues to correct higher, this might get pulled lower, this might get pulled higher. Now, finishing out the week, of course, the all-important U.S. jobs report. The expectation here is that we're not going to get anything earth-shattering. 39,000 jobs added. The unemployment rate holding unchanged at 4.3%. Of course, the Fed made its rate cut contingent on signs of weakening or cooling, as it were, in the labor market. So ostensibly, the markets want this to be a relatively cool number because it would encourage the idea that the Fed will continue to move on easing. It would also suggest that the Fed has a good grasp on the economy and is generally doing the thing that it's supposed to be doing. If this surprises higher, then I think perhaps the markets get a little bit unnerved, even though that's maybe good for the business cycle episodically. I think it would suggest that the easing that the markets want isn't necessarily coming in the degree to which they want it. And of course, we've seen already over the past week and some change, that's not a happy thought for risk sentiment. For what it's worth, looking at the U.S. Economic Surprise Index, it is well north of zero. And so we can see that the overall U.S. data flow here has tended to be generally surprising on the upside. And so the risk here perhaps is that this jobs data does indeed dilute these rate cut expectations and hurt sentiment in so doing. So looking at my exposure here, it hasn't changed since last week. I'm still long the dollar here against the Aussie, against the pound, against the euro, against the Canadian dollar. I am likewise here still holding this longer-term exposure in Brazil. This is until the end of next year. EWZ is the Brazilian market ETF. I've put on a little bit of a short position in stock indexes, essentially looking for this kind of sogginess that started to emerge last week to carry forward. We'll see if the risk reward here, which is how this thing ended up getting put on, ends up getting borne out. I'm still long silver, which continues to power higher, and liking more this tactical long shot I took on the bonds. They looked like they'd pulled back enough, and there was maybe a reaction bounce. We saw some of that here today with the rise of 0.8%. So still holding that. We'll see how it goes from here. And that is macro money for today. As ever, we are here Monday through Thursday right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.